Hello, you guys. Hello, you guys. This is Stacy, your tax buddy. You know what? I'm going to take the smile off my face because I'm talking about like taxes for sole proprietors. Ooh, man, it's painful. Ooh, when I say sole proprietors, I mean talk about Uber drivers, real estate professionals, actors, business owners. These people. A lot of times they come to my office end of the year, especially ones who don't have dependents, a lot of deductions, and they go, I have a big tax bill, and they get mad at me. And I say, hey, I'm the delivery man. I don't make the pizza. I'm joking. But hey, I'm here to help you guys because I don't want you to come to my office saying, oh, 20 grand in taxes. That's why I'm here to help you. Um, and a lot of times tax preparers, they work out a scheme with their clients and they get that tax bill even lower. That's a bad approach because what's going to happen is you run a chance to get an audit. Also, you're underreporting your income. What if you want to get a home someday or get a line of credit? Your tax return's not going to help you because your income will be so low, they're going to decline you. That's why I highly recommend you keep it honest, pay your taxes, and how they say, keep it moving or keep it pushing. There's two ways to do this. Um, like if you made say 30 grand a year, your tax bill be between 1,500 and 5,000 a year. You made 100 grand, it'd be almost 25,000 a year. Woo, that's a lot of money. To avoid that scenario, I highly recommend that you do two things. You either make estimated tax payments on a monthly basis, or you save that money and then you then use that money from your savings to pay your tax at the end of the year. So that way you have the money at the end of the year, as opposed to you waiting at the end of the year. Because for example, one year I had a real estate professional. The guy made 300K and he had a tax bill of 60 grand. He didn't have the money to pay it. And you know what happened? He procrastinated and then ended up happening that 60 grand turned into 80 grand. That's what I'm telling you guys. I highly recommend that you do estimated tax payments or savings. And let me break it down to you. What you need to do is you would put aside a percentage of your income at your marginal tax rate. To keep it simple, I recommend just do 15% of your earnings. Put that aside each month, and then once a month you make what they call estimated tax payments to the IRS on the IRS site. And I'll explain to you in the description on how to make the estimated tax payment on the IRS site. All you need to do is just put that money aside and make estimated tax payments. Do that on a monthly basis as opposed to waiting at the end of the year, because at the end of the year you might not have it. I mean, quite honest, a lot of people, business owners, are not that disciplined to save money like that. That's why I highly recommend that you put that money aside and make estimated tax payments. Another approach is I recommend that if you have the discipline to save that money and put into a high yielding savings account. That's right, high yielding savings account. What you do is you put that money, like 50% of your earnings, in a savings account. And then as the account build up, make some estimated tax payments. Or if you're really disciplined, you could put that money aside, save it at the end of the year, and then you could pay your taxes then. What's good thing about the high yielding account is you're building interest, plus you are putting money away for taxes. So at the end of the year, there's no big shock if you have the money. Suppose your tax bill is 30 grand, and then you have interest. You may like pay your tax bill. You may have like extra $800 in interest. And in some cases, when you put the money aside, you may put in too much. Don't worry if you put in too much, because just like how your employer would withhold taxes from you, a lot of times they may withhold too much. You get that money back as a refund. That's all you have to do, people out there. Just the key to it is, if you're an independent contractor, like an Uber driver, performing artist, musician, or you own a business, I highly recommend that you do one of two things. You make estimated tax payments, or you save a portion of what you earn. and try to do at least 15%. It's not like a lot of money, but you know what? You're going to get that back at the end of the year if you put in too much. Or you're going to at least have your tax bill covered. Or if you don't put in enough to cover your tax bill, at least it's going to reduce your tax bill. And opposed to on, say, like if you owe like 5 grand, if you make it periodic payments like that, what's going to happen is your bill may be just 200. I'm just saying that's why it's better to pay as you go, and opposed to waiting at the end of the year. Once again, you guys, thanks for listening. I said a lot of things here, but in the description, I'm going to explain to you the details on exactly how to do it. You guys, thanks for watching, and you have a good one.